Hey everyone, welcome back. And if you are new here, welcome. Before we start, thank you. This channel is growing because of you. Every view, every comment, every subscribe, I do not take that for granted. Now, what I am about to show you is something almost nobody is talking about. Let's get into it. 7 companies. 7 companies are holding up the entire American economy right now. Not 7 industries, not 7 sectors. 7 companies. They account for over 40% of the S&P 500. Their spending on artificial intelligence now contributes more to GDP growth than the spending of 330 million American consumers. And if any one of them misses an earnings report, if any one of them says the words, "We are slowing down our AI investment," the chain reaction would make 2008 look contained, because behind those 7 companies, there is nothing. The job market created almost no jobs last year. A Federal Reserve governor said the real number is probably negative. The bottom half of the economy is already in what one Deloitte economist called a recession. Household debt just hit a record. The middle class is shrinking. And the only reason none of this has collapsed into a crisis is because 7 companies in Silicon Valley are spending more money on data centers than most countries spend on their entire national defense. That is not a strong economy. That is a house of cards with a very expensive foundation. And today, I'm going to show you, number by number, link by link, exactly how fragile it is. In 2025, the United States created 181,000 jobs for the entire year. That is an average of 15,000 a month, 15,000, in an economy of 158 million workers. And even that number, even that pathetically small number, is probably too high. Because on February 23rd, Federal Reserve Governor Chris Waller stood up at the National Association for Business Economics Conference and said this. This is not a pundit, not a blogger, not a hedge fund manager trying to sell you something. This is a sitting Federal Reserve governor, a Trump appointee, a man whose words move markets. When the final revisions come in, payroll employment in the United States probably fell in 2025. Not slowed, not flattened, fell. Fewer people working at the end of the year than at the beginning. That has only happened 3 times since 1945, outside of a recession. 3 times in 81 years. And he went further. In the 10 years before 2025, the United States averaged nearly 2 million new jobs per year. In 2025, 15,000 a month. 0 versus 2 million. Those are not numbers from the same economy. The January 2026 report showed a small pickup, 130,000 jobs, but over 60% of those were in healthcare. The federal government shed 34,000 positions. Manufacturing finally added 5,000 after 13 consecutive months of losses. If you strip out healthcare and social assistance, the rest of the economy barely moved. Heather Long, the chief economist at Navy Federal Credit Union, called it a hiring recession. Companies are not firing people, but they are not hiring either. The job openings rate has fallen to its lowest level in over a decade. And the New York Fed's consumer survey shows that the perceived probability of finding a job has fallen to 43.1%, the lowest since the survey began in 2013. If you lose your job today, fewer than half of Americans believe they could find another one. That is not confidence. That is fear dressed up in a stable unemployment number. And yet, GDP is growing. The stock market is up. Corporate earnings are solid. The economy, on paper, is fine. So where's the growth coming from? Who is spending? Who is investing? Who is keeping the engine running? Because it is not consumers, not most of them. Here is what Bank of America's internal transaction data shows. The top 20% of income earners now account for 59% of all consumer spending. That is a record. The bottom 80%, 4 out of every 5 American households, account for 41%, also a record. In the wrong direction. And the gap is not closing, it is accelerating. Between January 2025 and January 2026, spending growth among higher income households held steady, but spending growth among lower and middle income households dropped significantly. One economist at Bank of America described the shape of the economy as looking like, his words, the jaws of a crocodile. The top is rising, the middle is flattening, the bottom is sinking, and the jaws are opening wider every quarter. This is what economists have been calling the K-shaped economy. In 2026, the K is more extreme than at any point since it was coined, and you can see it in the corporate earnings calls. It is showing up in how real companies talk about their real customers. Delta Airlines reported that revenue from premium seating was up 9%. Revenue for basic economy was down 7%. The same airplane. 2 completely different economies sitting next to each other. McDonald's cited a 2-tier economy and declining traffic among lower-income customers. At the same time, they reported a double-digit increase in higher-income customers coming in to buy value meals. Not because they love McDonald's, because they are trying to save money. When a $100,000 household chooses a value meal over a restaurant, the economy is telling you something. Coca-Cola reported that sales growth is being driven almost entirely by higher income earners buying premium brands. Lower income consumers are cutting back on everything that is not essential. This is not a temporary blip. This is structural. The two halves of the economy are moving in opposite directions, and they are accelerating apart. The economy is growing, but it is growing for some people. For the rest, it is shrinking. Income inequality, measured by the Gini coefficient, has hit a 60-year high. The middle class has shrunk from 61% of the population in 1971 to 51% today, barely a majority. Consumer prices are up 25% since 2020. Food prices are up 29%. The savings buffers built during the pandemic have been burned through. Household debt just hit $18.59 trillion, a record. Credit card delinquencies are rising. The National Foundation for Credit Counseling projects that financial stress will reach an all-time high in the first quarter of this year. And here is the detail that tells you everything. Dollar Tree just reported that it gained 3 million new shoppers. 60% of them come from households earning over $100,000 a year. When families making six figures are trading down to Dollar Tree, something in the structure of the economy is breaking. Evan Sheehan at Deloitte said it plainly. I think the bottom half of the economy is already in recession to some extent. Already in recession. Not might be. Not heading toward. Already there. And you can feel it if you talk to real people. A woman in North Carolina told CNN she fills her cart at the grocery store, then turns around and starts putting things back before checkout. A retiree said she is looking for work at 76 years old because she cannot make ends meet. Her only other option is filing for personal insolvency. These are not statistics. These are people, and there are tens of millions of them. The credit counseling agencies are seeing it in real time. More middle-income consumers, ages 45 to 60, are walking through their doors for the first time. Not lower income, middle income. People who never needed help before. They used to borrow to maintain their lifestyle. Now they cannot access credit. The doors are closing. The personal savings rate fell to 3.8%. Before the pandemic, the average was around 7%. Americans are saving less because there is nothing left to save. Walmart reported record traffic from higher income households trading down. Target's CEO said the consumer environment is challenging. Fast food chains are cutting prices to bring back traffic that has disappeared. The economy has split into two countries living in the same borders. One is thriving, one is drowning. The aggregate data is an average of both, which means it describes neither. So if the bottom half is struggling, and the middle is flattening, and the job market created almost no jobs last year, then what exactly is holding this economy up? The answer is one sector, one bet, one narrative, artificial intelligence. And when I say one sector, I am not exaggerating. The numbers are staggering. Hyperscaler capital expenditure, spending by Amazon, Google, Microsoft, Meta on data centers, chips, and AI infrastructure, is projected to reach $646 billion in 2026. $646 billion. That is roughly 2% of the entire US GDP. It is more than the combined defense budgets of Germany, France, the United Kingdom, Japan, Italy, and Canada. It is larger than the GDP of Sweden, larger than Argentina, larger than Singapore. And that money is being spent by a handful of companies on one bet. That AI will generate returns large enough to justify the most aggressive corporate spending spree in the history of capitalism. Meta alone announced $60 billion on AI infrastructure. Microsoft committed $80 billion. Amazon is building data centers on 3 continents simultaneously. AMD just signed a $60 billion chip supply agreement with Meta, the largest semiconductor deal ever recorded. This is not an industry, this is a gold rush. Except the gold has not been found yet. The companies are spending based on the belief that it will be. And nobody, not the CEOs, not the analysts, not the Fed, can tell you with certainty that it will. The entire bet rests on the assumption that AI will transform productivity fast enough to justify the investment before the money runs out. If it does, everything holds. If it does not, the largest capital misallocation in modern history unwinds in real time. In 2025, AI-related investment contributed more to GDP growth than consumer spending did. Let that sentence sit for a moment. The sector that most people interact with only as a chatbot contributed more to national economic growth than the spending of 330 million consumers. That is not diversification, that is dependency. And the dependency runs deeper. The stock market, the thing that makes the top 10% feel wealthy enough to keep spending, is also a concentrated bet on the same narrative. The Magnificent Seven now account for over 40% of the entire S&P 500. 40%. In one index that is supposed to represent 500 companies. The top 10% of households own the vast majority of equities. Their spending is driven by the wealth effect. When portfolios rise, they spend. When portfolios fall, they pull back. So here is the chain. And I want you to follow every link. AI investment drives corporate earnings. Corporate earnings drive the stock market. The stock market drives wealth for the top 10%. The top 10% drives consumer spending. Consumer spending drives GDP. Remove AI from that chain, and every link downstream breaks. Apollo Global Management calls this a single point of failure. Their chief economist, Torsten Slok, laid it out explicitly in his 2026 outlook. The U.S. economy is in a stagflationary environment. Growth is slowing. Inflation is stuck near 3%. The only thing preventing a contraction is the AI investment cycle. If it continues, the economy holds. If it stalls, the consequences cascade. And this is not hypothetical. We have already seen what happens when a single AI data point changes the mood. In January 2025, a Chinese AI lab called DeepSeek released a model that matched American performance at a fraction of the cost. NVIDIA lost nearly $600 billion in market value in a single day. The entire S&P 500 dropped. And that was based on one announcement from one company in one country. Now imagine what happens if Meta or Microsoft reports that their AI revenue is not growing fast enough, or if NVIDIA's data center revenue decelerates from triple digits to double digits. A 20 to 30% correction in the Magnificent Seven would wipe out years of S&P 500 gains. The wealth effect reverses. High-income consumers pull back. Data center construction halts. Chip orders slow. The one sector creating forward momentum goes negative. And there's nothing behind it. The rest of the economy is already running on fumes. Think about it. Who picks up the slack? The consumer? The consumer is tapped out. The government? The government just shed hundreds of thousands of workers. Manufacturing? Manufacturing has been contracting for over a year. Housing? Mortgage rates are still above 6%. There is no plan B. There is no backup engine. There's just AI and the assumption that it will keep delivering. Apollo has tripled its tail risk estimate from 10% to 30%. Moody's Analytics puts the recession probability at 42%. JP Morgan's consensus figure is 40%. The New York Fed model shows a 20.4% chance of recession by December. These are not fringe predictions. These are the institutions that price trillions of dollars in assets. They are all saying the same thing. The margin of error has disappeared. Mark Zandi at Moody's said it best. We'll most likely get through 2026 without a downturn. But nothing else can go wrong. Like nothing. We're pretty much on the edge. On February 24th, Federal Reserve Governor Lisa Cook addressed the AI question directly. She said growth could remain strong even as AI causes unemployment to rise. But then she said something that should have gotten far more attention. She said, standard monetary policy may not be able to fix an AI-caused employment downturn without also increasing inflation. The Fed is saying, out loud on the record, that if AI causes job losses, their normal tools might not work. They would be stuck. The textbook does not have a chapter for this. The closest parallel is the 1970s. Stagflation, rising prices and falling employment at the same time. The Fed's response triggered back-to-back recessions. Unemployment hit nearly 11%. It took a decade to recover. But in the 70s, the economy was diversified. Manufacturing employed tens of millions. There were multiple sectors creating growth. Today, the economy is running on one sector, and that sector is creating growth and potentially causing job losses at the same time. The Fed would be fighting a problem that its own tools might make worse. Apollo's Slok has said it explicitly. The environment is consistent with a stagflationary backdrop. And the one lifeline is a technology bet that has never been tested at this scale. And here's the part that makes it even more unusual. Europe does not have this problem. The Eurozone faces lower recession risk than the United States. Their inflation is falling. Their rates are being cut. They have no tariff-driven price pressure. The consensus sees a 20% recession risk in Europe versus 30% in America. The country that invented AI is now more economically fragile than the continent that adopted it slowly. That tells you something about what concentration does to an economy. This is why the number that keeps me up at night is not the unemployment rate. It is not the GDP print. It is the concentration. 40% of the S&P 500 in 7 companies. 49% of consumer spending from the top 10%. 60% of GDP growth from one sector, all of it connected. All of it dependent on the same story holding together. The economy is not weak in the traditional sense. It is fragile. It is an airplane flying on one engine. The pilot keeps telling the passengers that everything is fine because the altitude has not dropped yet. But if you are paying attention, if you are watching the gauges, not the altitude, you can see that the margins are gone. There is no second engine. There is no reserve fuel. There is just AI, and the hope that it keeps working long enough for everything else to catch up. That is not an economy firing on all cylinders. That is an economy where one bad earnings season from NVIDIA could do more damage than a financial crisis. And the 60% of Americans who own just 15% of all stocks, the ones financing groceries on credit cards, they are the ones with no buffer left. They are already on the edge, and they do not even know that the one thing holding the economy together has nothing to do with them. So what should you be watching? 3 things. First, Magnificent 7 earnings. Any sign that AI revenue growth is decelerating. The moment a hyperscaler signals AI is not returning what they expected, that is when the wealth effect reverses. Second, the labor market, not the unemployment rate. Watch the hiring rate and the quits rate. The quits rate has already fallen to its lowest level since 2020. If it drops further, the labor market is weaker than headlines suggest. Third, consumer credit data. The personal savings rate fell to 3.8%, well below the pre-pandemic average. If it falls further, consumers are spending out of necessity, not confidence. And that does not last. And here is one more thing. Watch what happens to Bitcoin and gold. Both have been rising alongside AI stocks. If AI falters and risk assets sell off, the question becomes whether capital flows into safe havens or whether everything goes down together. If everything drops at once, that is a liquidity event, not just a correction. The base case is still no recession. Most forecasters believe the economy threads the needle, but the needle has never been this thin, and the thread has never been this frayed. If you found this analysis useful, subscribe. Every video on this channel is about what the data actually shows, not what the headlines say. See you in the next one.